Imagine this. You walk into a bank, deposit $10,000, and the banker smiles, takes half of it, burns it right in front of you, and calls it a smart decision. You'd probably call the police immediately, because watching your own money disappear like that feels insane, but somehow this exact same setup exists, just packaged differently so it feels acceptable.
And the moment you dress it up in a suit, give it a fancy name like whole life insurance, suddenly it stops looking crazy and starts sounding like something responsible people should consider.
Yeah, today we're breaking that illusion, because what looks like a smart financial move on the surface often hides a structure that quietly works against you over time. So we're going to compare two paths side by side. One that's simple and actually builds wealth over time, and another that sounds impressive but slowly drains your financial potential without you noticing. First, term life insurance. It's simple, low cost, and does exactly one job. If something happens to you during the coverage period, your family gets financially protected, nothing more. Now on the other side, whole life insurance, it promises lifetime coverage, builds something called cash value, and gets positioned as both protection and investment, which already sounds like it's trying to do too much. Now let's talk about the cost, because this is where things start to feel a little uncomfortable. For the same level of coverage, one option stays cheap while the other quietly becomes expensive very fast. For a healthy adult, term insurance costs almost nothing monthly, while whole life can be several times higher for the exact same protection. And that difference isn't small, it compounds into something much bigger over time. And here's the part that almost never gets explained clearly. In the first year, a massive portion of what you pay doesn't go into your policy, it goes somewhere else entirely. So while you think you're building something for yourself, a big chunk of your money is actually funding someone else's lifestyle before your policy even starts working properly. And this is where it gets worse, because it can take many years before your policy even catches up to what you've paid. Meaning for a long time, you're actually sitting on negative returns. If something like this happened in the stock market, most people wouldn't tolerate it for long. They'd panic, exit quickly, and try to protect what's left instead of waiting years just to recover. But here, people are told to stay patient, keep paying, and trust that eventually things will balance out, even though for a long time the numbers are clearly working against them. A big reason this works is fear. People are told the market is dangerous, unpredictable, and risky, so anything that feels stable, even if inefficient, starts to look safer. The other reason is discipline, because many people struggle to invest consistently, so instead of fixing behavior, they're pushed into something that forces them to keep paying whether it's efficient or not. So what gets presented as a smart financial system is often just an expensive structure designed to compensate for lack of consistency, locking your money into something that removes flexibility instead of improving decision-making. Now, if you flip this approach completely, instead of overpaying for one product trying to do everything, you separate the roles, keep insurance simple, and let your investments actually grow independently over time. Now, instead of putting everything into one expensive structure, you keep your insurance simple and redirect the extra money into investments that actually have the ability to grow meaningfully over long periods. When you consistently direct that extra cash into something like a broad market investment, the difference starts small, almost unnoticeable at first, but over time it builds into something much more significant. That growth isn't linear, it accelerates as time passes, because the returns begin generating their own returns, and that compounding effect is what quietly creates the biggest difference between these two approaches. Meanwhile, the other option continues growing much slower, because a large part of what you're paying never actually gets the same opportunity to compound in the first place. So when you compare the outcomes after a long period, the difference isn't small. One path ends up creating significantly more value, while the other quietly leaves a large portion of potential growth on the table. And that gap represents a meaningful amount of money that could have been working for you, but instead was lost to inefficiency, all because the structure sounded safer at the beginning. Now, even though this option looks stable on the surface, once you factor in inflation, the actual growth becomes much less impressive, because the value of money itself keeps decreasing over time. So while it feels like your money is growing, in reality it's barely keeping up, which means you're not actually building wealth, you're just maintaining purchasing power without moving forward. And that's the part most people miss, because seeing any growth feels reassuring, even if that growth isn't actually improving your financial position in any meaningful way over time. Now, this is where things get even more interesting, because one of the biggest selling points is the idea that you can borrow against your own policy and essentially become your own bank. But what's actually happening is you're borrowing money that already belongs to you, and then paying interest just to access it, which creates a loop that benefits the structure more than you. So instead of giving you full control, It creates a controlled environment where your money is constantly cycling through rules and costs, making it harder to access and less efficient than it initially appears. And if this system isn't managed properly, the structure can start breaking down over time, where the internal balance shifts in a way that creates unexpected problems you didn't originally plan for. If you keep pulling from it without understanding the mechanics, the internal balance can weaken further, eventually reaching a point where the structure can no longer sustain itself the way it was originally intended. And when that happens, the consequences aren't just structural, they can also create additional financial pressure that shows up later in ways most people don't expect when they first enter the system. To be fair, there are specific situations where this structure can make sense, particularly for people with very high levels of wealth and unique financial needs that require long-term planning beyond basic investing. But for most people, using something this complex for everyday financial needs is like choosing an overly complicated solution for a simple problem where a much more efficient option already exists. If a financial strategy takes this much effort to understand and still leaves you with less control, it's worth questioning whether it's truly designed to benefit you or someone else. So start paying closer attention. Because when something requires this much explanation just to justify itself, it usually means the value isn't obvious on its own, and complexity is being used to make it feel more legitimate than it actually is. And in many cases, the more complicated the structure becomes, the easier it is to hide where the money is actually going, making it harder for you to see the real cost clearly. Even though it feels like you're in control of your money, the system is designed in a way that limits flexibility, so most decisions are already constrained before you even realize it.
And while your money is locked into this system, it's also missing out on opportunities elsewhere, which means the real cost isn't just what you pay, but what you could have earned instead.
Over long periods, that missed growth compounds into something significant, and by the time most people notice it, a large portion of their financial timeline has already passed without reaching its full potential. So when you step back and look at the full picture, it becomes clear that simplicity and efficiency often outperform complexity, especially when your goal is long-term financial growth and flexibility. When you zoom out and observe how all these pieces interact together, you start to notice that the system isn't optimized for your growth. It's optimized to sustain itself first. Because before your money can work for you, it first has to pass through layers that take their share, which means your growth always starts at a disadvantage from the beginning. And once you begin from a weaker position, even consistent effort over time struggles to catch up because the foundation itself was never strong enough to support meaningful growth. So even if you stay consistent and disciplined, the results don't reflect the same level of effort, because too much of your input is being absorbed before it ever gets the chance to grow effectively. This creates a disconnect between what you expect to happen and what actually happens, where the outcome feels underwhelming compared to the level of commitment you've maintained over time. And eventually, once enough time has passed, the difference becomes too large to ignore, forcing you to confront the reality that the structure was never as efficient as it initially seemed. At this point, the choice becomes less about preference and more about understanding which approach actually aligns with how money grows over time, instead of relying on something that only appears effective on the surface.
Because what feels structured and secure isn't always efficient, and what feels simple and boring often ends up being the thing that quietly produces the strongest results over long periods. And when decisions are based more on how something sounds rather than how it actually performs, it becomes easier to trust systems that are designed to look good instead of work well.
So instead of focusing on how complex or impressive something appears, the better approach is to look at what it actually produces over time and how efficiently it allows your money to grow. And once you start evaluating things this way, the difference becomes much clearer, because the results speak for themselves without needing complicated explanations to justify them. Which is why understanding the structure behind where your money goes matters more than how the product is presented, because the structure ultimately determines whether your money works for you or against you. Once you clearly see how the structure operates beneath the surface, it becomes harder to ignore where the inefficiencies exist, because the movement of money reveals what the presentation tries to hide. And when you compare what you put in versus what actually comes out over time, the gap becomes difficult to justify, especially when simpler alternatives don't create that same level of loss along the way. At some point, efficiency matters more than appearance, because consistent small losses add up over time and quietly reduce the total outcome in ways that aren't obvious at the beginning. And as time passes, those small inefficiencies don't stay small. They expand into larger gaps, because compounding works both ways, amplifying gains in efficient systems and losses in inefficient ones.
And by the time the difference becomes obvious, it's often too late to recover the lost growth, because time is the one factor that cannot be reset once it has passed.
Which is why the real decision isn't about which product sounds better, it's about which structure allows your money to move freely, grow efficiently, and actually work in your favor over time.
When everything is simplified down to its core function, the difference becomes obvious. One approach is built around protecting and growing your money efficiently, while the other prioritizes structure over actual performance.
Because when you separate protection from growth, each part can do its job properly without interfering with the other, creating a cleaner system that's easier to understand and more effective over time. But when you combine everything into a single complex structure, neither part performs at its best, because the system becomes constrained by its own design instead of being optimized for either protection or growth. And once you recognize that, it becomes easier to see why simpler systems consistently outperform more complicated ones, especially when the goal is long-term growth without unnecessary friction along the way. So at the end of the day, the decision comes down to whether you prioritize simplicity and efficiency or complexity and appearance, because both lead to very different outcomes over time. And once you understand how these systems actually work beneath the surface, it becomes much harder to fall for something just because it sounds sophisticated, because real performance doesn't need complexity to prove itself. So if you already have something like this in place, it might be worth taking a closer look at what you've actually put in compared to what it has returned so far.
Because when you see that difference clearly, it becomes less about theory and more about your actual money, and that's usually when the perspective starts to shift in a meaningful way.
At that point, the question isn't whether the idea sounds good anymore, it's whether the results actually match what you expected when you first started. And most people already know that answer.
So take a moment to actually check your numbers and see where you stand. Because awareness is the first step toward making better decisions with how your money is structured.
And if you want more content that helps you understand how money actually works instead of how it's presented, then staying around will probably save you from a few expensive mistakes. Because once you start looking at money this way, it changes how you evaluate every decision going forward, which is exactly why most people never question the system until it's already too late. And if that feels a little uncomfortable, that's probably a good sign, because the moment something starts making sense is usually the moment you realize how long you've been looking at it the wrong way. So before you move forward with any financial decision, it's worth pausing for a second and asking whether the structure actually makes sense, or just sounds convincing on the surface. And if this helped you see things a little differently, then staying connected will probably help you avoid similar mistakes in the future, because understanding how money works is what actually changes outcomes over time.